as you wrote in the Financial Times this week, you covered two financial banking crises in the past. How was this different from those?
Well, it was very striking, this current crisis, because in some ways it was similar. Bank crises are always about a collapse of credit, meaning trust in the banking system. Fractional banking doesn't work without trust. And that's what sparks bank runs. And that's true of the South Sea bubble. It's true of today, everything in between. But what was really different this time around was the speed of response and the virality, because so much of it was conducted on social media and through mobile banking channels. And what we discovered is that the Fed system for trying to quell a banking crisis just are not in the 21st century when it comes to trying to contain a panic. We also found out that the contagion risks associated with small to medium-sized banks are significant in a world of social media and mobile banking. You go back to the savings and loans crisis, and no one really cared if small banks collapsed because it didn't really create such a chain reaction. In the current hyper-connected world of digital finance and digital social media, it really matters if panic erupts, if trust is lost. The good news is, of course, that we actually had fairly small overall losses from this crisis. I mean, 22.5 billion if you look at what the FDIC says. And that's pretty small compared to the history of banking crises. The bad news is, though, that what SVP was very much a symptom, not a cause. It was a symptom of the fact that the financial system has had way too much too cheap money for too long. Many financial institutions and investors have been taking really dumb bets with that cheap money, engaging in a version of a carry trade, and eventually those chickens are going to come home to roost. So I think the best way to see what happened in March is a symptom, not a cause, of a financial system that is seriously dislocated.
Chris, we heard from Jamie Dimon, the head of JP Morgan, this week, saying he thinks we're past the worst of it. There may be another failure or two along the way, but it's not really fundamentally going to continue to be a banking crisis. From your point of view as an investor, where might the next shoe drop? Because one of the problems here, as I understand it, was unrealized losses on balance sheets. I'm not sure that's only at the banks.
No, I agree, David. And I don't know, I don't disagree with Jamie Dimon. We may be over the worst. I don't expect a lot of failures, but there's going to be a lot of pain. First off, when the Fed raises rates from 0 to 500 in 9 months, commercial real estate, particularly office real estate, is going to be hurt by that. Cap rates have risen, and while they haven't reappraised, those properties are down probably 20% in value. And the people that loan the money on those buildings are usually the regional banks. So we'll probably enter a period again this fall of extend and pretend, where building owners have wiped out their equity and they throw the keys back at the bank, and the bank doesn't want to pull back that loan. They don't want the commercial real estate. So I think we're going to have a long hangover period of pain just simply because the Fed raised rates so quickly.
Gillian, I also wonder about another area, and that's private equity, which has just exploded, as you know. I'm not sure how transparent some of the losses might be in private equity. The valuations certainly must have come down on some of those companies.
Well, David, that sounds like a masterly British understatement, because the reality is that private equity is private and we just don't know. And what is really striking about the last few years, the gigantic credit bubble, and I do call it a bubble because of the cheap money, was that more of it happened through private capital markets than we've ever seen before in history. And the problem with that, and the good news about that, is when it starts to implode, it doesn't necessarily immediately hit the regulated banks. And of course, the regulated banks are at the core of credit transmission in the economy. But the bad news is that private equity can't be seen quite so easily what's happening inside. It is private. And the marks tend to take a very long time to come down. So you are going to see more of a hissing sound, if you like, as the bubble deflates, not a dramatic pop. And one of the downsides of that is that there's going to be a lot of quite unpredictable chain reactions, because we just don't know the complications of where these losses will end up being felt. One area I'm very curious about right now is university endowments, because endowments have to produce a certain amount of income each year to pay the bills, to qualify for charitable status in some areas of the world. They're not like sovereign wealth funds that can just swallow losses for a few years. And a lot of university endowments have dashed into the private equity and VC markets in recent years, and they could start to see the outlook looking pretty nasty in the next few years.
As I recall, Chris, in the past, you have expressed some skepticism about private equity. I think you pulled back, didn't you, at CALSTRTS? What about pension plans and their investments in private equity? Is there vulnerability there?
Well, David, we've actually been a steady state investor. I'm skeptical of the valuations, just as Gillian said. But, you know, a lot of private equity, you can read it from the employment numbers. They're still kind of steady, so they're not writing it down. But they're also fundraising, so they're not motivated to write it down. And I think really that when you look at private equity, particularly as Gillian said at the endowment level, there's no distributions. We're not seeing any transactions. Merger Monday has disappeared. So it is putting a strain. I think there's a very serious liquidity crunch going on around the world, not just in the USA. We can survive it, but it's very tough. People with cash are hoarding it. And right now we're not getting any money back from private equity or real estate. And that's putting a pinch on everybody's balance sheet. So people with negative cash flows are going to find it harder and harder to keep looking at new opportunities. It just is a long, slow grind. I don't think it's going to lead to an immediate liquidation where somebody sells a good asset on a fire sale, because there are other people, like she mentioned, the sovereign wealth funds willing to buy that up. So it's a tough period.